Summary of the book Investing in Stocks in the Way of Warren Buffett. Every art has its people, so when we mention music we remember Beethoven and Mozart, and when we mention poetry we remember Almudena and Alfarazdak, and when we mention investment it must be the first to come to mind, and that giant billionaire, and the excellent student of his teacher Benjamin Graham, the greatest investors and financial expert in history, is a school on its own. The art of investing in stocks. He laid solid foundations and rules for successful investment in stocks, and he applied them in his work accurately, and he was able to reach a huge number equivalent to the gross domestic product of a number of countries, as his wealth amounts to more than $90 billion, noting that he did not benefit from any inheritance, inside information, distinguished relationships, or even a job with a large salary. And he says that there is no secret to building wealth, and that any investor who is able to achieve wealth if he follows the same principles and methods that he used, and Pavel represents a global phenomenon in the field of investment to the extent that won the famous book, which is only in his book The Month of Investing in Stocks on the Way of Warren Buffett, included in it the principles and techniques of investing in stocks according to the method of Warren, which are indispensable for any investor or interested in this field. In order not to prolong you, let us browse through this book, which has sold about 1.5 to 1 million copies, and stop at some of its precious gems that are of interest to those looking to invest their money in an effective way. Summary of the book. The book Investing in Stocks in the Way of Warren Buffett reviews the investment strategy that Buffett pursued in building wealth, as he summarized it in 4 main rules, which are the rules for work, the rules for management, the financial rules, and the rules for investing in value, and we will deal with these rules in some detail in the following. 1. The rules for action. What is meant here is that everyone who thinks of buying new shares should look at the matter as if he is buying a company, not just a security, and this in turn requires the investor to study the work and performance of the company, and to answer 3 important questions, which are the nature of the company's work understandable to him? Is the company reliable? Are there indications of the possibility of its continuity in the long term? Are the possibilities of development for the company available in the future, which makes investing in its shares profitable in the long run? It is believed that investors' understanding of the mechanism of work carried out by the company is one of the important things in making a successful investment decision. There is no sense in owning shares in a company or even owning the entire company if the investor is ignorant of the nature of its work and the activities on which it is based, because the matter is nothing more than an adventure doomed to failure. On the other hand, Buffett is not interested in the shares of companies that rise suddenly, but rather the shares of that company that are able to continue, develop, and achieve profits over a long period of time. As for the potential and prospects for the company's development in the future, Buffett believes that it can be judged by the availability of 3 conditions called the trench recipe, which is the nature of its products, the extent of the market need for them, and that these products do not have a close substitute that completely eliminates them, and that they are not subject to censorship. Therefore, the trench or line of defense widens whenever all these conditions are met in the company, which makes investing in it encouraging and successful. 2. The management rules. From Pavel's point of view, it is not enough for the investor to know our information about the company whose shares he will buy, but rather he must know the characteristics of its management and its manager. In this regard, Buffett says, I do not want to invest in companies headed by a director, and they lack impressive qualities, regardless of the attractiveness of the company's business or its profits. Here, he stresses the need to answer 3 questions related to managers, and are they rational? Are they honest? When transparent with investors? Can the administration resist institutional and bureaucratic dictates? As for the rationality of managers, they can be judged by decisions related to profits and the way they are distributed or invested to develop and expand the company's business. Successful management is the one who knows how to reinvest the company's profits to increase its value in the future. As for the element of transparency in the middle, it becomes clear by answering 3 questions that usually revolve in the minds of investors. What is the approximate value of the company and the extent of its ability to fulfill its obligations? How well is her manager doing and getting through the management's mission rules? Also, institutional dictates, subjection to regulations and instructions strictly, which, from Buffett's point of view, is a negative element that hinders the company. On the one hand, it leads to resistance to change, and it may lead to expansion and acquisitions. For the purpose of flexing muscles in front of competitors, submission to institutional dictates may also lead to imitation of competitors and granting huge compensation to managers, such as Lamgazal's show of force. 3 financial rules in order for the investor to avoid falling into the trap of attractive and sometimes manipulated numbers, which do not give a realistic picture of the company's situation. He must look at the profit rate within 5 years and not be satisfied with the annual reports issued by the company. And here the investor must take a number of principles: financial, which is the focus on business profits; shareholders' equity, not the market, earnings from the sale of the share. Buffett believes that earnings per share do not reflect the quality of a company's financial performance, but return on equity. It is the profit resulting from the goods or services produced, and when this profit is achieved, it is reflected in the earnings per share in the stock exchange, which is a real rise that resulted from the improvement of the company's financial performance, and not just a bubble caused by random speculation in its emergence by studying the profits of the owners, not the cash flow. Some companies may announce high numbers in cash flow reports with the aim of raising their market value, and the idea of deception is summed up about the amounts that must be deducted from the annual profits, modernizing machines, and making improvements to maintain economic performance. Of course, these improvements can be postponed and deducted from the cash flow, which leads to high numbers, and then the investor will not be fooled. Accordingly, Buffett suggests using the criterion of owners' earnings rather than cash flow. Investing in high-margin companies, Buffett tends to undercut expenses. He believes that it should not exceed a specific percentage for every dollar of income, and he follows the method of reducing the workforce to a minimum. He was able to advance the Washington Post Company as a result of reducing production costs to 80% in 5 years. If the company withholds earnings to restart, then the market value of the stock must increase by at least $1. He believes that if the withholding of earnings for the purpose of restarting does not result in an increase in the market value of the stock by $1, then it is better to distribute the dividend to shareholders than to restart. Because there is no economic feasibility in this case. For rules of value investing, value investment expresses the purchase of what its price has decreased and its value has increased and invested, and appropriate opportunities come to sell it after its price reaches what is equal to its real value or more, and this matter depends on two conditions determining the value of the work and buying when the work is offered at the price that carries a good discount of its value. In my opinion, the value of a business is the sum of net cash flows, profits, and the owners that are expected to be achieved during the life of the company, discounted by an appropriate rate of 10%, which is the percentage proposed to calculate the actual value of the shares, and Buffett bought the cola company in 1988 according to this method, and paid for it 5 times its book value, as he was sure that the real value of the company is bigger, which prompted him to buy its shares. This process has been one of Buffett's greatest investments, and on the other hand, Buffett believes that the most important thing of all is knowing the right moment to act. When the price of shares in the market becomes less than their actual value, the time has come to buy. But if it turns out that the value of the work is more than the value of the share, even by a small percentage, then one must refrain from buying, even if the price seems attractive. Buffett's portfolio management strategy emphasizes the importance of adopting a rational portfolio management strategy. While the majority of investors are accustomed to following two strategies in this regard, the first is managing the investment portfolio linked to an index, the second is the active management of the investment portfolio. Bafton believes that these two strategies have very little chance of success, because it is based on a theory. By today, everything that can be predicted for sale at a profit without looking at its nature, and this logic leads to failure because it is impossible to predict the fate of the market in light of the complexities of the business world. Buffett suggests an alternative strategy that he calls the focused investing strategy. This strategy is based on the practical principle of focusing investments in strong companies. Any homeland interest in investment diversification? From Buffett's point of view, the number of companies in which we invest our money should range between October 2nd, 10 companies as a maximum. In addition, Buffett advises, after some time, to distribute the invested funds equally among the companies. Rather, the largest amount of them should be employed in the most well-established companies, and the rest should be distributed relatively to other companies based on their strength and its importance, and Buffett adds to the foregoing that the investment must follow a long-term plan ranging from 5 to 10 years.